Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, this week was a little bit miserable. It started with a bit of a sell-off on Monday. Renewed recession fears, of course, was the main cause. And the market really stayed down for the rest of the week. Although on 2 or 3 days there was a good attempt at a morning rally, only to see it sell off again in the afternoons. The real concern this week that's been surfacing is the worry about the mortgage bond insurers. These are insurers for the bonds, heavily linked with the mortgage industry. And of course the concern here is that these insurers will not be able to meet their liabilities in the down-stricken industry. The other concern, of course, is that we haven't really seen all of the bad news from the mortgage industry come to the fore yet. The feeling is that this really just the tip of the iceberg that we've seen, and there's lots more bad news still to come. And the depressed valuations of the housing market, together with worries about mortgages going forward, has certainly started to weigh on consumer sentiment. And most retailers have been posting rather poor results during their earnings season and offering very little uplifting guidance going forward. So really the market consolidated last week, and this will be seen quite clearly on the Nasdaq Composite Index chart. Let's take a look at it right now. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark. At 2,208 was the worst level before we had the pullback that we've had in the last week or so, on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback of consolidation over the next few weeks, before then the market would probably turn southwards again. So it's still pretty much doom and gloom out there. The Asian and European markets fared pretty poorly as well last week, and the general malaise in the stock markets around the world still seems to continue. There is the odd bright spot, of course, like Amazon.com on Friday announcing a 1 billion share buyback. News like that will always have a positive effect on the markets. But recession fever has really taken hold in the US, and until the rest of the world looks at that in a more pragmatic view and realizes that the US still has strength in depth, and that any recession is likely to be fairly short-lived, I don't see the markets really having much of an upturn. Of course, the US is being a little distracted at the moment with election fever. We've just had Super Tuesday in the primaries, where a lot of states have really showed their allegiance. Politically, I think that as the election proceeds, it's got to help confidence in the US going forward. The markets always hate uncertainty, of course, so as the election unfolds and it becomes clearer who is going to win, at the moment it looks like the Democrats are going to regain power. Once the market feels it knows the direction that the US is headed, it will bring some stability and some more confidence. The technical picture, though, is still not good. We're right at the 500-day long-term moving average, and this is offering a lot of resistance to an upward move for the market. Whether it will penetrate that on the upside remains to be seen. We'll be watching closely. Until next week, it's goodbye from London.